Welcome to the Seattle Investors Club podcast with Julie Clark and Joe Bauer, where we share the nuts and bolts of real estate investing from our 20-plus years in the industry. Sit back, relax, listen, and immediately take action. Are you ready? Here we go.
Welcome to the Nuts and Bolts of Real Estate Investing podcast. My name is Joe Bauer, and I'm here with my co-host, Julie Clark. Julie, how are you doing today?
I'm doing good, Joe. I'm feeling a little motherly today, actually.
Really?
Yeah. We were just talking, Joe and I and our special guest, Keith, today, we're just talking about how Addison, one of my girls, got a mild concussion last week. And that woke up this morning with a headache after romping around at the pumpkin patch with no issues and everything this weekend. And then I was stuck there thinking, oh man, is she trying to go to school or do I take her to school? And, so I elected to not take her to school this morning. So if you hear anything crazy in the background, that's her celebrating that she's not at school. But I think I'll take her after we're done with this today. Yeah. Makes me very, I got my mom hat on a little bit this morning is all I'm saying, right? Normally I have to worry about Joe, guys, because he's out running in the woods or extreme heat, it looks like recently, or, bears and other things, crazy other campground people with guns. I have to worry about Joe. But today I'm actually worried about my own kid. Yeah.
Interesting.
So make me feel better, Joe. Distract me. Tell me what you're up to.
Well, I actually am in Kenmore, Washington, so I'm not really all that interesting. But another thing that you can worry about is we did get mountain bikes. So we've been cruising around, jumping off crazy stuff. And we just got back from Bend, Oregon, which was amazing.
Oh man. Have you been up, where you got to go on your mountain bikes would be super cool, is Big Sky.
Oh yeah.
We have
good
some
idea.
Awesome mountain biking stuff up there, right? At that, what is it? Lone Star Mountain.
Oh man.
Where you can take your bikes up on the lift and they have all kinds of stuff. Love it.
Yeah, that's another thing that I don't know if we talked about. I can't remember. Have you ever been to Telluride?
I have not, but I keep hearing everybody talk about it.
Holy crap.
Yeah.
So
Is it on the Epic or the Icon Pass? Do you know?
It's not on either, unfortunately. Oh. It's its own thing, and it would cost a lot of, it's a very expensive ski hill, but we were there in the fall and it was one of the most beautiful places I've ever been.
I have heard super awesome stuff about Telluride. So did you guys put a bike rack on the van?
We did. We got the smoking deal on bikes in Bend, which was kind of unexpected. And we had to buy a bike rack right there because we needed to transport them back to Seattle. And it's not the ideal bike rack because, we got the van. So we want to get this cool bike rack that also does snowboards and all this stuff. So we basically bought a bike rack that we're now going to have to sell or decide maybe we'll just keep it for later. I don't know.
Well, there you go. If anybody needs a bike rack, drop it in your comments below. And our boy Joe here will deliver it to you for the small price of whatever. Awesome stuff. Mm-hmm. Well, good stuff. Well, I'm trying to find a good way to butcher in our awesome guest today, Keith Pitsch from Loan Depot. I don't think I'm 100% with my comedic hat on today, so I'm just going to introduce him. Keith, what's up?
What's up? I have a bike rack. So
yeah.
I don't need a bike rack, but I got one. That's hilarious.
Well, we were just talking about concussions before we jumped on the live podcast here, and it turns out our boy Keith, who is one of the smartest, most intellectual and charming, Keith,
thank you.
Has had 5 concussions, and I feel you'd be like a genius if you get banged around so much. So, what were the 5? Skiing?
So water skiing, 2 from baseball.
Do you need glasses or something? I mean,
no, the worst one was,
what?
I was back in high school and this guy threw a fastball and I thought I could get out of the way and it actually hit me so hard it broke my helmet.
Whoa.
So when they talk about helmets and head safety, wear that stuff, man. It's got a purpose.
My first thought was, wow, did that guy like get into the big league pros with a big fast pitch or what?
You know, he had the speed and velocity. His accuracy was failing him, as you could tell by hitting me in the head with a fastball. But
Lordy.
So yeah, that, and then the other two, I hate to admit it, but they were both playing flag football for underdog sports leagues here in Seattle.
Oh yeah.
So yeah, flag football, no helmets, no nothing. So yeah.
Oh man, I remember the underdog sports league. I played a little flag football one year. Have you done that, Joe? Did you play in that at all?
I didn't. I wish I would have. I don't even remember it being around when I was growing up.
Is that still a thing?
Mm-hmm.
Oh,
it is still a thing. They got all sorts of different sports.
That's for like people who are older wanting to still, right? Or what isn't?
Yeah, act like they're 20. Yeah. That's exactly it.
Exactly. Good one. Love it. Yeah. In fact, it'd be fun to have a Seattle Investors Club team. Right?
Oh yeah.
There you go. We'll have to organize that.
Yeah.
Well, let's jump into it because today is a Tuesday and I'll be rolling down to our weekly meetup down in Burien. If anybody wants to join me next week, since you're listening to this now from 12 to 2 p.m. at Angelo's Fine Italian Dining in downtown Burien. Come join us 12 to 2 every Tuesday, but we'll save all that for the end. So Joe, kick us off.
Yeah. So Keith, we'd love for you to basically give us your life story. No, but take us back and kind of let us know.
Remember.
Yeah. If you can remember.
It's coming back to me now.
Yeah, the synapses in my brain aren't firing. So
yeah. So of what you can remember, we'd love to hear when you grew or where you grew up, how you grew up, how that led you to this real estate occupation.
Gotcha. Yeah. So here today, I sit in the mortgage industry as a 20-year professional. But I actually grew up in Washington. I was born and raised in Washington, down in the thriving metropolis of La Center, if anybody knows where La Center is.
Wow.
It's just north of Vancouver by about 16 miles. If you don't know where it was, I don't blame you, but now there's a huge tribal casino. I think it's Illini or Ilani or whatever right there on exit 16. So that's my exit where I grew up. And I grew up in a really different part of the real estate world. I grew up on a farm raising cattle and growing ginseng. So after 18 years of farm life, I decided to get out of there and come to this big city. So I moved up to Seattle and went to UW. And while I was going to UW, I got involved in finance through my mom. She got me a job up at US Bank. The regional manager down in Portland where she was working moved up here, and she was like, oh yeah, you should interview with them. And I got into the fine world of finance in 1999. So
more so because somebody was like, oh yeah, my friend's moving up, they have great jobs, or you were like, I'm interested in finance. Was it more of an accidental type of, somebody, so you jumped in where you could get a job?
Well, I was trying to avoid student loans like the plague. So I was like, what is my quickest way to a job? And like I said, my mom was working at US Bank at the time, and her regional manager moved up here. So I connected with him, and he's like, yeah, well, how are you? So I got to work for 3 years as a universal banker inside an in-store branch. We were inside the grocery store in Larry's Market. If you all remember Larry's Market in Bellevue, it was one of the most awesome independently owned grocery chains ever. It was like PCC or Trader Joe's before PCC and Trader Joe's in Metropolitan Market were cool. So I got my start there, and my main job at that was to sell stuff for the bank, right? And as a part-time college student, I needed to hit my sales quotas, and the quickest way to hit sales quotas was doing big home equity lines of credit. So I would pounce on every single person that came to the teller line or came in and had questions and say, hey, how about we get a home equity line of credit? Let's get a home equity line of credit. You need a home equity line of credit? I can help you with that. So I did that through my college years. And then after I graduated, I went to work for a mortgage broker at the time down in Tukwila. It's actually, Julie, it's funny because it's just 2 blocks away from Angelo's down in Darien, my first office for the mortgage broker. And I managed their warehouse lines with Option One, is at that time in the early 2000s was a subprime mortgage lender. And so I managed their warehouse line and fundings and all the process there. And I was like, okay, this was fun. And I continued my evolution. And 2 years after I joined with that broker shop, I went into the wholesale world. So instead of working with the consumer, I was now working with the mortgage brokers and selling them money. So I did that for 6.5, 7 years until the mortgage meltdown of 2007. And I remember that day very specifically.
As being on both sides of the coin there, did you pick up something that the average Joe wouldn't pick up because you have some secret knowledge on something that's on both sides of the coin? You get what I'm saying?
Well, I think my deal meter got really fine-tuned because in the retail world, retail loan officers are doing somewhere on the low end, they're doing 2 or 3 deals a month. On the high end, they're doing 10 to 15 deals a month. So the amount of business that they see is not too huge. When I was in wholesale, the wholesale team that I was running, we were closing anywhere between 150 to 170 loans a month.
Wow.
So we had major volume, and just the velocity of our pipeline was turning so fast. It really allowed me to raise the red flag really quick on a deal. So I know I can look at a deal in about 2 seconds and tell you if it's going to work or not. And if it's not going to work, how we can structure it that it will work in the very near future or as quickly as humanly possible for that situation. So my time in wholesale was super awesome for that fact. I got to start wholesale still when we were documenting stuff. There at the end, we were just like, hey, you got a credit score? Great, here's your loan.
Yeah.
But so when the mortgage meltdown happened, I diversified. I opened up an insurance company as well as continued to originate loans. And, just kind of trounced through the mud for the next, 3, 4, 5 years until things started to get healthy again in late 2012 and 2013, where I just gave up the insurance gig and said, you know what, the mortgage world's happy enough and healthy enough again, I can get back into that. That tumultuous time, you just didn't know what underwriting guidelines were going to be when you woke up in the morning. It was a really unsettling feeling to know that you had a pipeline of clients that were pre-approved or under contract, and you never know if you woke up the next morning and the underwriters decided to change their guidelines based on a new tolerance or based on a new issue that was being talked about at the government level. So
what was it like there then that time? Did you still have people wanting to borrow during that time, and it just, you had to just ride the roller coaster of the daily changes on if they're qualified that day or not? Were people, is that what it was? Or were people just not, was everything at a standstill? Or what's your insight on that? Was business still transacting? It was just more unpredictable, or?
Yeah. The folks that had money weren't necessarily needing more money. And could structure their deals accordingly and with the market. The folks that got pinched were, in my opinion, middle America, which was making enough money to qualify. However, given declines in appraised values and depreciating markets, as well as changing of guidelines, would just get pinched. So it was really tough going from a position of the prior 10 years in my career that I could say with a fair amount of certainty to people that, yeah, your loan's going to fund. We're on schedule. We've got the underwriting approval. We're all moving forward. In that dark day of the mortgage industry, you just said, well, that loan is on its way to funding and recording. And until it funds and records, I can't guarantee you anything, because it was literally moving that fast there for a while. So, it was a lot of uncertainty, both for us as professionals and for our clients. So, yeah. was not a fun time.
Well, let's talk about where things sit today as we move towards, we're going to talk a little conventional basic stuff, and then we'll move towards the investor stuff.
Yeah.
With your superpowers of your insight there. So what primary residence rates, for your primary, where are they at today? Or what about for rental properties, which are, up to 4 units?
Rates right now are still amazing. What I did a quick look here. If you're buying with 20% down on the owner occupied front, you're looking in the high 3s, low 4s based on credit score. If you're looking at something in the non-owner occupied range, you're going to be around 5, maybe a little north of 5. So it's still an amazing time to lend and to borrow money because money is super, super cheap. And there's still conversations going on about recession and this and that. And I'm so happy to be here in the Pacific Northwest, where we're going to be a little bit more insulated per all the economists that I follow, based on our diversification of income and job base. So I'm super excited because maybe we can find some more deals on the wholesale and on the flip market side. So.
Yeah. Curious though, how, we always talk about how we're insulated out here in the Seattle area a bit, right?
Yep.
But yet we all felt an effect back in, the downturn of the last economic crisis where we still were impacted, even though we were probably insulated at that time as well. Right.
Yeah.
That makes sense. So
yes and no. I think that we have a lot deeper roots now in this past 10 years in the tech world in comparison to 2007 when the wheels fell off the wagon. Just the exponential growth of Amazon, Microsoft, Google's doubling down on our market here, and so many of the secondary services that those giants have brought to the area are amazing for us here.
They're solidly here now, not like are they staying? They're here.
Right, exactly. They're here, and I have to say the best thing for us is the crazy prices down in the Bay Area, because
right.
we look like a discount market in comparison.
Right.
So
was there like a rule of thumb with your primary residence, like if you can drop 1 point or something, you should refinance? Is there some sort of smart guy math that, you should pull the trigger on? Because there are costs involved to do that. When does it make sense to refinance?
Yeah, that's a great question, and a question that I get to field all the time, because we have to weigh that, what is the opportunity cost of refinancing right now? Yeah, I could save better in rate. I can save better in maybe removing mortgage insurance if I bought with a high leverage loan to begin with. So a couple of the key factors that I just like to throw out there. Number one, if you got mortgage insurance and you've been in the house for 2-3 years, it's probably time to reevaluate that in one way, shape, or form. Whether it's working with your servicer if you have a conventional loan to remove the mortgage insurance, or if you're on FHA, it's just time to refinance and get out of that mortgage insurance because you have an equity position now.
Well, let's be clear on that. So you can't, I think there could be some confusion out there. If you have an FHA loan and then, your equity gets to above the 20% mark, it won't automatically drop off. You've got to get out of your FHA loan. Is that correct?
So that's correct. It's not, there's 2 ways with FHA. And usually how FHA is applied, since it's got one of the smallest down payment requirements at 3.5%, usually people just bring in 3.5%, right? So you are now 16.5% away from an 80% loan to value. In that scenario, the mortgage insurance is for the life of the loan, the whole 30-year term, 15-year term, whichever term you pick, that mortgage insurance is going to be there. Unlike a conventional loan, when you would obtain 78.9% by federal mandate, it has to come off of your loan. The servicer can no longer collect mortgage insurance. It's done. What the other scenario with FHA is if you put
let
down.
me break it down a little bit further there. So on the conventional, when you hit that 78.9%,
Yep.
is there something that the borrower needs to do to make that happen, or the lender will do something internally to, everybody seems like they're so far behind and stacks of papers on the desk or whatever, right? Is there something somebody needs to do if somebody's probably on here thinking, well, shit, that's me right now?
Yeah, no, the lender should be removing that MI. It's a federal mandate. The mortgage insurance company should also have a trigger for the mortgage servicer that says, "Hey, we're pulling this off. The policy is now satisfied." But the one thing I want to get really clear: it's not 78%, 78.9% of your current market value. It's 78.9% of the original loan and purchase price, right? So if you go out there and say, hey, you should remove it, the servicer gets the opportunity to reevaluate your value of your house. Not all servicers are going to go through and say, oh yeah, I see that you only put down 10% when you acquired the house, and now fast forward 2 years, you've got another 10% appreciation, so you're now at that 78.9%. That is not a default request or requirement of a conventional loan servicer. The borrower in that respect would have to then engage the servicer and say, hey, I'd like you guys to reevaluate the value of my property and see if I can remove my mortgage insurance.
And is there a cost involved? Do they need to pay for an appraisal or something?
It's servicer specific. Some servicers will say yes and they'll charge you. Some servicers will say yes and they won't charge you. And some servicers will say, no, that is not our policy as a mortgage servicer.
Is there a way to choose which mortgage, when you're choosing lenders, is there a way to choose which mortgage servicer, or you're just kind of like luck of the draw?
Negative ghostwriter. That's the only problem with that whole situation is, once that mortgage loan is made and it's sold on the secondary market, you're really at the whim of how the servicers want to manage their portfolios and where you fall in the food chain. So they may bundle your loan in a bundle of $50 million or $100 million loans worth of loans and sell it to another servicer. So no, you don't have control over servicers. The only time that you would really, actually, there's no time that you're guaranteed a servicer. Banks change all the time as far as what their servicing portfolio will look like. And so, there's not really a way to control servicer.
Excellent. So let's go back to the original question. Is there a rule of thumb like, hey, my rate can go down by a point, I should refinance, or does it need to be 1.5 points? Or is there some sort of benchmarky thing we can let our peeps know here?
So like we said already, mortgage insurance, it's an obvious question to be asking. The next question is rates. There's not, in my opinion, there's not like a 1% or a 0.5% or what that is, because I don't like blanket statements like that, because the bigger the loan amount you have, the more a 0.5% will impact it as opposed to 1%. So in
addition, your life circumstances might have changed, and maybe there's a reason why you need to, lower your payment regardless, or, whatever.
Yeah, I had a client come to me the other day. I helped him with the purchase, and he's like, oh, hey, I see that rates are better. He was about 3/4 better in rate. And I asked him a really important question. I said, yeah, we could refinance you and you're going to save a couple $100 a month, which is great. How long are you going to be in this house?
Right.
Oh, that's a great question. We're looking to relocate in like 2 years. Like, well, then it doesn't make sense to you, because the costs associated with the loan between title, escrow, appraisal, underwriting, and refunding an escrow account, you're looking at $6,000. So you're not going to get that through a cost benefit in the next 2 years.
Right. What about, I always think about oh man, you got to reset your amortization. Now, if you were in your loan for a while, maybe let it keep rolling and instead use a HELOC or something like that, because your amortization, you're having to reset, right, on your interest versus principal payment.
Right.
Any thought that goes into that?
There is thought, and that also gets back to how long are you going to be in the house.
Right.
Because you're absolutely right. When you re-amortize or restart a loan, every payment that you pay, well, let me step back. The interest on a mortgage is front loaded, right? So when you pay that first mortgage payment, you are paying a super majority to interest and to the bank's bottom line, and a very small percentage of that payment is going to a principal reduction. So if you're 2, 3, 4 years down the road in a amortized mortgage, you're paying substantially more towards your principal than you are if you restarted on a new 30-year fixed. So all things being equal, you have to take that into account too. We have some really cool tools that we can look and benchmark your current amortization versus a new proposed amortization and really see where the cost benefit is and where your break-even points are. So that's a tool that I use with all my clients to make sure that they're making the most educated decision about their mortgage finance, because the elbow is connected to the shoulder, connected to the neck, connected to the head, right?
I mean, guys, how like you're supposed to go to the doctor once a year and get your checkup and all that? It kind of sounds like Dr. Keith here should be on the list as just a check-in, right? I mean, that's something you could probably do super quick, right? Without,
Yeah.
Plus he's fun to talk to and he's got good jokes sometimes. So I recommend you guys take this serious today and put it on one of your, annual check the box things, check in on where my rate is, where my amortization is, what's out there. Just a quick coffee and conversation with Keith will go a million miles for you, for sure. Yeah. That's why we're so excited to have him on today. Well, let's keep trucking here.
Perfect.
What's the most important to the lenders these days? Is it credit score, consistent job history, cash reserves, or how's the pecking order there?
I would say E, all of the above. So we've got the conventional and FHA markets where they look at the four ingredients to a mortgage is what I talk to people about. And those are income, assets, credit, and then the collateral, which is the house. So all four of them are equally important. They have different reasons why they're important. The income is really important from a debt to income standpoint. I'm sure folks are familiar with that term. The lenders are looking for your total debt load not to exceed 50% of your gross income. So that's an important benchmark to know if you could qualify for a mortgage or how much mortgage you can qualify for. The credit, having a good credit history with the last 12 months, most specifically that there's no major derogatories. If you have a major credit event in the last 2 or 4 years, bankruptcies, foreclosures, those are scrutinized pretty heavily, as well as your credit score. A lot of folks don't realize the way that mortgages are priced. If you have a 741 credit score, you're kind of at the top of the food chain. And yeah, we can go down to the 620s and the 580s, but that rate environment looks substantially different than a 741. So you have to look at, if you have a lower credit score, your risk in the eyes of the mortgage company is going to be higher. So you're going to pay a premium in rate. I think the credit is one of the things that the consumer and the folks listening here have the most control over, that and who you're working for. I mean, if you're just not making enough money in your job and you can take that leap of faith and go find a new one that pays you higher, that's always a possibility. But the credit, if you can dial in the credit, that is your quickest way to cost savings in a mortgage. And then finally, the collateral, just making sure that it's lendable and there's no health or safety issues on the house. And one other thing that just came up in my appraisal that I had, it's moss season. So appraisers don't like to see moss on the roof. And I know it's a super simple fix to have the roof cleaned, but please clean your roofs before we send the appraiser out.
Right. What are some other things we need to have done before the appraiser comes out? You need to strap your hot water tank. I mean, you guys all know this because we're talking to investors, right?
Yeah, well,
carbon monoxide detectors, strap your hot water tanks, clean the moss off your roofs, take care of any life safety issues.
Here's one that caught me, Julie, the other day. Had a seller that relocated, and my buyer was buying their house, and the seller didn't pay their electric bill, so they turned off the electric when we went to do the appraisal. So just that's coming with houses being on the market longer now. When somebody moves out and relocates, they don't have top of mind their electric bill anymore. So it was funny. So that's just a simple.
So it just causes a delay, right?
Yep, it caused a delay because we had to send the appraiser back out there once they turned the power back on.
Right.
Yeah.
Hey guys, it's Julie here with a quick break from the show to discuss an opportunity some of you may have interest in, which is to work more closely with me. On almost a daily basis, I get calls from investors and brokers, both new and experienced, asking me for guidance or advice. I love helping you guys out, and it keeps me on my toes too. So with that said, I wanted to let you know that I have a private broker coaching community called the VIP Education Community. And the best part is that it's 100% free. That's right, it's free to join. So whether you're a traditional broker or a broker investor, my VIP education community offers personalized one-on-one coaching from not just me, but also from my experienced broker friends with expertise in all disciplines of real estate and real estate investing. We'll teach and share our modern marketing strategies, our tech and lead generation resources, plus teach you how to identify or offer up opportunities for yourself or for your clients using techniques such as seller financing, lease options, land entitlement deals, BRRRR investing, flipping, multifamily or commercial coaching, whatever you like. We've got it all covered for you. The future of real estate is changing fast, and to stay in the game, it's time to learn about all the options you can offer your buyer and seller clients, as well as, if you want, learn how to use those skills to grow your own real estate portfolio. If you'd like more details about joining my VIP education community, reach out to me at julie@seattleinvestorsclub.com or text me at 206-910-2985 or just send me a Facebook message. My new favorite phrase is community equals confidence. So let's navigate the future of real estate together. Now, back to the show. Well, we already talked about so what is debt to income ratio? Let's do that one for a second. What a lender's looking for on the debt to income ratio these days. And is that different, or how does that conversation go a little different if we're just talking about a HELOC versus,
So debt to income ratio is a super, super important ratio for mortgage underwriting. We got into this ugly, naughty mess into 2004, 5, 6, and leading up to the mortgage meltdown in 2007 because we weren't doing our due diligence in this bucket. So debt to income ratio is you as the borrower, your ability to repay the mortgage. And so we don't want to see any borrower have a debt to income ratio higher than 50% on an owner occupied and 43% on a non-owner occupied house. So what we'll do is we'll look at your gross income. And I want to point out gross is the number that we use. So before we pull out taxes and health benefits and all that good stuff for 401k contributions, we're going to use your gross income. We'll talk about self-employed in a second, but as far as your W-2 wage earner, we're going to use your gross income. And we'll then match that up to your debts and the new mortgage obligation and make sure that it doesn't exceed the 50 or 43 respectively.
And are we talking 12 months, 24 months?
We want to say that you've been in your job for the last 24 months. There's some wiggle room there, but we want to see a 24-month history in the same line of work. And then we're really looking at the last 12 months if you're just straight up salary person. If you have any variable part of your income, commissions, bonuses, overtime, we will take a 2-year average of that and making sure that 2-year average is supported. There's some caveats there that we can look at a 12-month look back, but I don't like to get too deep into that because there's some very specific circumstances around that. So
for you real estate brokers listening, I'm sure you guys know this because you're real estate brokers and you deal with loans all the time, but you're in the 2-year category.
Yes, yeah, real estate agents. If you pay 1099, if you're doing a Schedule C, or you're your own thing as an S corp, and you set up your 1125s and you want to roll that way, we're doing a 2-year average. And here's where we flip the coin and we go to the self-employment. We do a 2-year average of the self-employed's net income, right? So W-2 folks, we'll use gross income. All you find 1099 and self-employed people, we're going to use your net income. So it's not your, for your real estate brokers, it's not your gross commissionable income. It's what you put on your tax returns at the end of the year as far as your net income is concerned. So it causes an awkward conversation because a lot of folks read information. Oh, I hear that you can use gross income and this and that on this blog or that blog. Well, you fall into a different category of employee, or employed, I should say, and you don't get to use gross. You get to use net because you're writing off stuff like your car and your marketing expenses.
And which is the trouble with real estate investors, like broker investors, my favorite type of person on the planet, is you get caught up in the, let me write everything off. Mm-hmm. And then you shoot yourself in the foot. Right? Because now your net income, because you fall under the self-employed, I guess. But if you're paying yourself a salary through some sort of S thing, then is that recommended then for real estate broker? Or
well, it's a cleaner way to structure it. However, I haven't seen an S corp set up where the W-2 income was substantial enough to pay for, or excuse me, to qualify for the mortgage obligations that they wanted to go out and get.
Right.
Because really, per the tax code, as I've been advised by my CPA, I just have to pay myself a standard base salary. So what I usually see on those W-2s is like 24 or 24,000 or 36,000. So they're paying themselves $2,000 or $3,000 a month.
Because they're trying to hit the self-employment thing, is what the focus is there, right? But right.
So
now we're going down a little rabbit hole because we're just talking. What if somebody, paid themselves a lot more than that? I'm not schooling myself well enough on, if you were paying yourself, let's say you made, $250,000 a year as a real estate broker, and you paid through does that make any sense what I'm saying? Why don't you pay yourself more rather than the reasonable amount?
You should, but so here's the diminished returns and why I love alternative mortgages as far as non-QM mortgages is, okay, the game, you got to pay to play the game, right? So you're going to pay to play the game in a couple different ways. You're either going to pay through income taxes and qualified income, or you're going to pay to play the game through not paying income taxes and doing non-QM loans, which are outside of Fannie Mae, Freddie Mac, FHA, and VA's boxes, and pay a little higher interest rate. Right. So then we can look at
the latter being the better.
Right. You can look at different ways to qualify. You can look at bank statements. You can look at just the debt service coverage ratio or the rental income of the property that you want to buy. You can use asset depletion. So you got to, again, kind of like that annual mortgage checkup, you got to look at what is the best way, especially in the self-employed or the 1099 world, what's the best way to take this on, right?
And it's so individual. There is no, like, you can read a blog and figure out what's best, because everybody's situation, life situation, personal finances, job history, credit scores are different. So you can't, that's why you've got to educate yourself by listening to podcasts like this, or better yet, calling up Keith and going to have a coffee with him or something, because it's got to fit you like a glove for your own personal stuff. Just like, like I say, real estate investing, all this, you see all this stuff can be very distracting on social media about, in order to be considered a real estate investor, you got to achieve or hit certain marks or be able to say you've done how many transactions or how much volume or whatever. But I like to school it back and say you're a real estate investor if no matter what you do, if you're, doing something outside your primary residence, or even if you're lending, using like money off a HELOC off your primary residence, and you're accomplishing your own personal goals. Maybe that's, getting to go on some badass trip to Telluride, which we've decided is overly priced, right? So, that's winning. It's so, everybody stop watching what everybody's doing and just focus on yourself. Get yourself on the path by having a bench, certain lending on your bench.
Yep.
Keith Pitsch at Loan Depot here on your bench. Do you loan outside of Washington, Keith?
Yeah, that's a great question. Thank you for asking. But before I answer that question, I want to just reiterate, this is what I tell all the clients that come into my office. Look at your fingers and look at your fingerprints. That is unique to you. Every single mortgage that I do is unique to that client that's sitting across the table from me, because in my 20 years of mortgage experience, I have never seen two clients that are the same. Zero, right? That's over 10,000 transactions. There's no two clients that are the same. So be careful of those backyard barbecue conversations. Well, I got 3% on my mortgage, and you come in and we talk and you're in the mid fours. You're just a different mortgage scenario, right?
Right.
I'm licensed in multiple states. Loan Depot is a national lender. I specifically can represent in the state of Washington, Oregon, California, and Idaho. So I got the West Coast dialed in.
Nice.
And
so
then
it informs me that we have, people listening to this podcast from over 30 states out there. So if you're across this beautiful land and not with us here in the Seattle area, for God's sakes, come visit us. We're one of the most beautiful places on earth, and come mastermind and hang out and check in. We'll welcome you with open arms and show you around town. So if you're from another state, give us a shout out down below. However that happens, I don't know. Joel will tell you later. Let us know where you're from. That would be awesome, right? And then if you feel like calling Keith because you're in one of those states, I highly recommend it. That's why we hand select, only the top people that we know what they're doing to be on this podcast. That not only do we know they know what they're doing, but they have compassion and they lead with service and not greed. Let me put it to you that way. Big shout out to our friends at Certain Lending, Flynn Family Lending, Loan Depot. That's who we love. Circle of love right here, guys. So
integrity leads to longevity.
There you go. Well, let's jump into the investor stuff. So what's the best, from your perspective, what do you think is the best way for someone interested in real estate investing to get started? If they're just getting started, would that be like a house hack, or, a single family residence, or maybe even can you house hack on a duplex or a triplex, live in one of the units of a small multifamily? And let me remind you guys, if you guys go out and understand and talk to Keith and talk to Nee at Certain Lending and, talk to everybody else on your bench, you don't have to start with flipping or wholesaling.
Nope.
You guys can go right to the good stuff and go into the multifamily if that is what interests you. You don't need to, start the other way with single family burrs. You can learn straight out the gate, because as I mentioned before, I always see the progression of people like, let me start wholesaling or let me start flipping, because that's what all the gurus are teaching. Mm-hmm. Some people start flipping and then they go, wow, I know how to generate leads now. It sure would be a lot easier just to wholesale them. I see wholesalers want to be flippers, and then flippers actually go back to wanting to do wholesaling. Right? Even on development side stuff, right? Instead of being a developer that gets all the entitlements, spend all the time, you get to be an expert like our friend Augie. What's up, Augie? And now you can start, literally wholesaling huge deals. So, usually after people flip for about 2 to 3 years, if they haven't lost a bunch of money and gotten scared off, they realize, oh crap, I'm paying through the nose in my taxes. Maybe I should have kept some of those properties, right? It's almost like the dial is turned even in Seattle. Everybody's focused on that right now. Then they start, either maybe they go off and they start building new construction, or they, start wanting to buy apartment buildings, right? Moving towards the passive instead of the active swinging the hammer type stuff. Not only is it better for, being able to live your life more freely, but it is, that passive cash flow It's good for taxes as well, which is a topic that seems to, for some reason, get talked about last. But if let's just start over. If somebody's getting started, they're looking to do their first few deals. Maybe they are super qualified, or maybe they're not. What are the best ways for the starter version people to get started?
Yeah. Number one, education is key. You got to sit down with a mortgage professional and understand your options going into it. Whether you want to house hack and jump into an FHA deal with 3.5% down on a fourplex and live in one and rent out the other three, or you're highly qualified and you go in and just buy a bunch of rentals for, you just want to reallocate capital and build a passive income. The one biggest error that I see and oversight that I see is the Geronimo, let's run down the hill and go get after it and quit my job and try to do real estate.
Right.
That is, my friends, a deal killer in so many different ways. I get that you hate the 9-to-5 and reporting to a little office with a keypad and key card and all that water cooler talk, and you just want something different. Please be educated before you quit that job, because
here's another thing too I see happening. People become successful flippers. They're like, oh, I'm doing good. I'm replaced my income. I'm making as much or more of my income flipping homes now than I am in my day job that I've had for however long. So now that I've done that, now I'm going to quit my day job because I'm making, enough money flipping homes, right? And then all of a sudden you go, shit, I do not want to flip homes anymore. I want to keep these. And now how do you qualify?
Yeah, you don't. You got to qualify in a non-QM mortgage. You don't traditionally qualify anymore. So
this is actually counseling for you guys too. You not only need to go to Keith to learn about like what lane you fit in as a borrower. You need to go talk to him about, should I quit my job and when should I quit my job or change careers? Like this would, when you're trying to decide that, quit coming to real estate investor meetings and asking everybody. You need to call your conventional lender and you need to ask them that question.
Yep.
Right.
Yeah. And so I'm not just a conventional lender. I'm also doing some non-QM brokerage stuff through additional underwriters, which, they have some really awesome products, but a well-placed plan is just a recipe for success. So
into that, tell people what non-QM and non-traditional, what does that exactly mean?
Right. So we got a really good definition of what a qualified mortgage, QM stands for qualified mortgage. And it's a definition that came out of the Dodd-Frank Wall Street Reform Act of 2013 as the Mortgage Overhaul Act. So a qualified mortgage basically says, hey, if your clients meet the ability to repay, it's well documented, they've been in their job for the last 2 years, and we've got the W-2s and tax returns and pay stubs and all that good stuff in the file. Everything that clients just get, if they roll their eyes, you want so much documentation. That will satisfy a benchmark of a qualified mortgage, which is the ability to repay. It's also the biggest hurdle when people get into the investor world, whether they quit their job prematurely or they now have a real estate portfolio that's so vast that they're having a hard time debt servicing the portfolio. From a traditional lending standpoint, we can have some additional or secondary options to Fannie, Freddie, FHA, and VA. So what I do in that respect is I specialize in two other non-QM loans. One is bank statements, and then the other is debt service coverage ratio. So the bank statement loan, it's still set up like a 30-year fixed or a 5/1 ARM, but we're looking at just the deposits that come into your bank statement. Self-employed, we can use a 12 or 24-month average and use that as your qualifying income as opposed to a traditional tax return and what the 2-year average is on your net income. So it helped a lot of folks qualify in that respect. I'm working with a few folks now that on their tax returns, they showed $40,000 worth of income as a net. But when we look at their business bank statements and I use a 12-month average on their business bank statements, I actually now have a qualified income of over $20,000. So it really changed the game from their inability.
And why is that? What kind of deposits are you seeing? Or does like a balance in there mean anything? Or are we just talking about deposits?
We're just talking about deposits. We're not looking at balances due. We're just talking about deposits. As long as the lender can make an argument that there's cash flow coming in sufficient to service the mortgage debt that they're about to partake in, they're fine. These are non-QM mortgages, so they're not going to Fannie Mae, they're not going to Freddie Mac. So they can be a little more lenient on how they come up with the ability to repay. The thing is, you're not going to get Fannie Mae, Freddie Mac rates. You're going to get non-QM rates. And those rates are typically anywhere between a point to 2 points higher than market rate, right? So if we're looking at non-QM market, you're in the sixes right now. And everybody, this is the knee-jerk reaction. Oh my God, sixes, that's horrible. And the investors that I'm working with, they look at 6%, 6.5%, sometimes 7%. They look at that as a welcome invitation to continue their real estate investing endeavor.
Still cheaper than hard money.
Say again?
Still cheaper than hard money.
Yeah, still cheaper than hard money.
And term.
And it's long-term lending, right?
Long-term.
That
right.
Hard money has a great use and purpose, and our boy Nee's amazing at it. But when it comes to the point that you got to pay off that hard money lender, you want to have something there. And this is an awesome opportunity to get in a 5-year ARM or a 30-year fixed and qualify in a non-traditional fashion. Because
the problem, remember everybody, with hard money, even the rates are down so low today, even as low as maybe even below 8% for experienced people. It's maybe we'll just for ease purposes say 8 to 12%. Mm-hmm. Even if you can manage that, the challenge with hard money at a certain point, if things don't go perfect, is that it's not long-term money. So you don't, if you need longer periods of time and somebody's offering you a 6 or a 9 or a 12-month loan, that's all you get, right? Mm-hmm. I know there's some lenders out there that I think for certain properties, maybe for BRRRR properties, maybe you can get longer. I'm not here to talk about that today because I don't know all the details myself in detail. But if you have questions about that, let me know and I'll get you the answers. But it's that, man, if you can, when you're looking at a loan, not just focus on one thing, right? Not just the rate. You got to look at the terms.
Yep. Looking at the terms and looking at what your full picture is. If your goal is to continue to acquire and you're in acquire stage, I'm not saying acquire at any cost, but acquire at a prudent cost that you can continue to move forward. Working with the same group, the illustration I gave you on the bank statement, if they structured their business where they showed enough income to qualify, it would be more tax obligation than the difference in mortgage payment. Does that make sense?
Right.
Right. So it's like I alluded to earlier, you're going to pay to play the game one way, shape, or form. How do you want to pay to play the game? Is it going to be in an interest rate or is it going to be paying the tax man?
And can you give us maybe like a specific example, a little bit more deeper on the bank statement loan, like a scenario or what type of situation would that be? Like you have rental properties. I mean, when you're collecting cash flow distributions or, when would you be having deposits, but not the income?
Right. So, I've done this for a lot of restaurant owners. They're a high deposit transactionary basis and they show very little income. In that case, the gentleman was running an S Corp and he probably had in deposits coming into his restaurant, he probably had an average of about $98,000 in deposits a month, but he was only giving himself a W-2 income of $4,500 a month. So it wasn't enough to buy his $1 million house that he wanted to buy. So we could use
Keith, it sounds like we've done a transaction together, because that maybe before I knew you, that sounds exactly like it wasn't a Japanese restaurant, was it?
Was the house in Briar?
No.
Okay.
Lake Ridge.
Yeah, the house was in Briar on this one. I was like, that would be too freaky.
That would be crazy.
Well, yeah, plus I would have called you. If you were the listing agent, I would have called you and explained this to you, because that's how I roll. I don't like listing agents not to know what's going on the buyer side. So yeah, but no, the restaurant owner, any self-employed business. I've worked with another Seattle Investors Club investor who he flips houses. So he's got like one deposit every 4 months for a sizable amount of money. But, when you back out cost of materials and labor and what he's paid himself and what he's paid his subs, he doesn't have a lot of documentable income. So I just take his 4 or 5 deposits throughout the year and average them out, divide by 12, right?
That's odd to me, though, because, it's a little bit confusing, because it's ignoring all the expenses that money's obligated to pay.
Yes.
Yes, it is.
That is, well, see, and here's the situation that they're approaching it with. As a W-2 employee, we're ignoring all of the taxes being withheld. We're ignoring your 401k contribution. We're ignoring all of your health, dental, vision benefits that are being pulled out. If we were being 100% prudent in the Fannie Freddie FHA world, we'd be underwriting off of net income, not gross income, right?
Right.
So the non-QM market is saying, hey, I understand. And here's the caveat. You've got to be in business for at least 2 years for yourself. You can't just open a business license yesterday and have this. You've got to be in business for 2 years. And so that 2-year threshold is, okay, this guy knows enough or this gal knows enough that they can run their books. So that's the benefit of the doubt that the non-QM market is giving to the self-employed, that, hey, we're giving you the true benefit of the doubt and giving you gross revenue as opposed to your net revenues, which is how most self-employed people get disqualified for lending.
Right. Good stuff.
So
how does somebody's rental income count towards qualifying?
It's awesome. There's a lot of cool ways to use this. So in the conventional and A-paper world, what we do is on a new acquisition, we'll give you 75% of the rent that the appraiser comes back with when we do the appraisal. So they'll do the market approach and they'll also do a rental income survey. And we'll give you 75% of that to offset the new proposed mortgage. So this is where a lot of first-time investors do the house hack of a duplex or a tri or a fourplex. They'll go out there and maybe they don't have a strong enough income to support 100% of the quadplex right out the gate, but they can use the prorated 75% of the proposed incomes of those other 3 units to offset that mortgage and qualify.
And if one's vacant, it doesn't matter? Even
if it's vacant, yeah, it does not matter. You can go in there and buy it. It's typically in the 4-unit or the multifamily space. Typically, a few of those units will be rented. Even if they are under market, we're going to give you what's on the rent survey.
Awesome stuff.
Yeah. Now, on the flip side, here's another cool non-QM mortgage that we can do right now, which really helps the investor in a handful of ways that I'll expand on. But we have a debt service coverage ratio approach, which means basically as long as your rent income covers the mortgage payment, including taxes, insurance, and any HOA dues that are required on the property, you're game on, you're approved, right? So look, just to give you an example of that, say your rent is $2,000 and your proposed mortgage payment with taxes and insurance and let's not say there's HOA dues, but if there were HOA dues was $2,000, you're approved. I don't have to put any income, any employment on that application. Done.
Boom.
Boom.
That means for those of you out there, living in a townhouse or wherever you're living, if you could rent out your house for, and if you're off a little bit, right, then you're only qualifying for the part that you're off.
Right. Correct.
Right.
You only have to close that delta. But the cool thing about the debt service coverage ratio approach is that this gets rid of the requirement of 10 properties. They don't care how many properties that you own.
If they're qualified under that way.
If they're qualified that way, because I don't have to worry about the other properties, because from a bank standpoint, I know that this property cash flows.
Let me get a little deep dive on this now. Let's say in our area here, the chances, so that probably means if you're having your rent cover all your costs of your rental in this area for like a single family house or something like that, that probably means that your loan amount is not maxed out, right? You're leaving some equity in there in this market, right? Because the rents aren't going to cover probably the market value, maxed out, whatever, 80%, 90% loan to value. Now you're left in that case probably with some equity in there. Now what do you do with that equity?
Well, if you can qualify traditionally, I would send you to one of my resources that could do a non-owner occupied HELOC on your house.
And let's talk about that for a second.
Yeah.
So go ahead.
Yeah, non-owner occupied HELOCs are very much out there. The debt service coverage ratio approach that I've been working with mostly is for folks that are doing BRRRR purchases. So they went out, they got their hard money for their 9 months or 12 months or whatever, and we're doing the takeout of that loan. So it's really super quick and easy for them. We just get an updated appraisal based on their value. And it's typically somewhere between like 70 and 75% loan to value. So yeah, you're leaving some equity on the table. The different outlets that are doing non-owner occupied HELOCs, I send a lot of them to BECU and KeyBank. So you can then tap in that equity delta and get a home equity line of credit for your working capital. The only issue with going to that market is you do have to be a traditional money. I bring money in as far as W-2, 1099 that has a good net income kind of situation. So you have to traditionally qualify for those.
On the HELOCs.
Yeah, on the HELOCs.
Right.
Yeah.
Do you know, is the amount of equity needed to use a HELOC different than, if you were using a HELOC on an investment property versus a primary? Is there any type of difference on loan to value or anything like that?
Yeah, substantial. Yeah, I mean, there's companies out there in the HELOC world that will leverage up to a combined loan to value between the first and second mortgage balances. They'll go up to 95%.
Yikes.
On owner occupied. On non-owner occupied, I see typically around 80. Maybe somebody's got 85, but I haven't seen it. Combined loan to value.
Awesome.
Yeah.
So the point of this, guys, is that the best idea when you're getting started in your real estate investing career, or even if you're halfway through it or into it for a few years or into it for a long time, is to reverse engineer. It's probably time for a check-in if you've been around for a while. Give yourself a Christmas present, sit down with Keith and see if there's a way that he can shake some money out of your Christmas tree there, or we'll say your holiday tree. I don't think we're supposed to say stuff like that. We'll call it a money tree. How about that? And, reverse engineer into, especially if you've been in the game for a while, into what lane you are as a borrower, right? You might not realize that you can qualify to take on investments that you might not think you're qualified for because you just haven't had the right review of your situation, or you just don't know enough of the details you don't know what you don't know, right? I think there's probably a lot of people out there, they put a primary, a loan on their primary residence, and that beyond that, they don't really know about lending beyond that, right? I think a lot of people, they're learning about hard money, but they're not learning about these non-qualified, non-QM mortgages and non-traditional mortgages that Keith is zeroing in on for you guys here today.
Yeah, and to echo that sentiment, Julie, the non-QM market It started to trickle back shortly after the Dodd-Frank Act went into effect in 2013. But really, with the health of the real estate market over the past, 7 years, they've really evolved into more product offerings, a more common sense approach to underwriting. And I kid you not, there's a new lender out there that's coming out with a new way to qualify almost every day now. And it's really awesome to see. Now, I made this joke. I also teach continued education for my fellow mortgage advisors. And I was teaching one on Friday down in Portland. And I said, the second that the subprime market or the non-QM market is priced better than the Fannie Mae, Freddie Mac, FHA world, I'm out. That's
Right.
when you know shit's going to hit the fan. So, it does cost money to play the game, but playing the game, there's some really amazing returns. So even as I sit here today, I guarantee you in the next 3 months, there's going to be some new way to look at an investment property or to underwrite a fourplex. So,
and these are the things we talk about, guys, at our meetups. Keith comes to our meetup. He's usually at our one in Burien. And then once in a while, we'll also drop into the one in Redmond, which is odd because you're closer to that.
I'll be there on Thursday. I can't make it down today, but I'll be there in Redmond on Thursday.
And these are the things we talk about on a weekly basis. Can I ask you? I'm going to take 5 more minutes at the most here. Okay. So just want to dumb it down, reverse it backwards a little bit. If somebody wants to, how can an investor skip hard money? Not that we don't love our friends at Certain Lending, but even those guys, the reason why we love Nee and Certain Lending and Charles and those guys and Israel's over there now is because they are honest. They'll tell you, go talk to Keith instead on this one, right? That's and again for you, you're like, go talk to Nee, or they'll go say, go talk to Beth at Flim Family Lending. I love how you guys are all working together. But if somebody wants to get started and they have some flexibility in their lifestyle, meaning, they're not in a primary residence with kids in school, already got their loan taken up their credit. Let's say they've not, they qualify for FHA or VA or, maybe you want to say something about a 203K. For somebody that wants to flip or do a BRRRR, how can they get into a deal real quick without using hard money, using those loan types? Yeah,
so FHA has a rehab loan out there, which is super awesome. FHA requires it to be owner occupied though. It's owner occupied.
But some people are young and footloose and fancy free, and they can just go move into whatever.
It's the biggest opportunity for those folks in that category right now to go buy the crappiest house on the block and just bling that bad boy out and sit on a big pile of equity. And so both FHA and Fannie Mae have an owner-occupied remodel rehab loan, which is awesome. There's 2 sets to it. There's either the Streamline, which is repairs under $35,000, or there's repairs over $35,000 is the standard and requires a little more due diligence with an inspector. But long story short, you can leverage up to 65.5% on FHA of the after repaired value, or you can do 95% on the Fannie Mae deal. As of right now, I always have to throw this disclaimer out. Underwriting guidelines are subject to change without notice, right? But as we sit here today on the 29th of October, boom, you're ready to go.
But we're talking with 3.5% down, right?
Yeah, that's 3.5% down. It's an amazing product. The other opportunity that a lot of people don't realize, Fannie Mae actually launched a non-owner occupied rehab loan of 85% total loan to cost this past summer. So if you're looking to find a non-owner occupied investment, single family residence only, so there's no duplexes or anything of multifamily function, you can do a Fannie Mae rehab loan on a non-owner occupied now. It's awesome.
But that means that you have not, is it Fannie Mae? Is that different then? Can you have owned a home in the last 3 years? What's the qualification? How do you slip in the radar on that one?
Yeah. So there's no first time home buyer requirement on that. It's just that you're buying that property for non-owner. I mean, it's great. You do have to traditionally qualify from an income and debt to income standpoint, but it's pretty awesome.
Man, guys, there's almost too much to cover here, right? You need to go get your menu from Keith. I'll say it once again, right? We can't talk forever because we all got to go get down to these mastermind meetings or do some business here. But you just hear what we're saying. It's endless. If you know the right people to talk to, go talk to them and get this sorted out for yourself, right? I guess that's about it here today, guys, because we're running out of time. Keith, anything you want to add before we wind down?
Conversations are free. And to your point earlier, Julie, that the world of flipping has become such mainstream in HGTV world that's what people think that they have to go do. The world of real estate is so vast, and so educate yourself up front, and then you can choose your own adventure.
Right. We didn't even jump into the cash out refinance situations and when that's doable and not doable. So
much equity out there. And guess what, guys? Your equity is doing zero for you. So leverage it and go put it into more real estate.
Let's do it.
Let's do it.
All right, guys, these are the things that and gals, these are the things that we talk about every week at our weekly masterminds. And we have a bunch of those with a bunch more kicking off here by the end of the year. But the ones that we have rocking and rolling right now are every Tuesday from 12 p.m. to 2 p.m. in Burien at, what's the address? I think it's 601 Southwest 153rd Street at Angelo's, which is an Italian joint in Burien. We have our own private room there. Last week, it looked like we were having an impeachment trial. Did you see the picture that I took? I'll have to post that for you guys. There was like a big flag in the background. There's a bunch of people. To me, it was kind of funny. But this week, we every week we talk about just whatever anybody wants to talk about. Keith is usually there to cover the whole conventional side, and he's usually there to cover the whole hard money side. And we have Beth and those guys show up. If you're ever interested in lending and you want an introduction, just show up at one of those meetings and we'll be happy to connect you. If you can't make it, hit me up at julie@seattleiinvestorsclub.com, and I'm happy to connect you anyway. I always got your back here. Our other meetings are on Thursdays, 10 a.m. to 12 p.m. in Redmond at the Family Pancake House right off Redmond Way there. Get some Eggs Benedict, have some great conversation. Again, who are these meetings for? They're for wholesalers. They're for flippers. They're for buy and hold people. They're for builders. They're for conventional lenders, hard money lenders, private lenders. If you're an individual private lender, come join us. Brokers, everybody. You will be surprised at what you will get out of these meetings. Sitting face to face with anywhere from, let's say, 8 to 20 people is about the perfect size. Can it get bigger? It can get bigger, but we prefer it about that size because we accomplish a lot of deep dive stuff. So we hope to see you at one of those meetings. Other than that, Joe, where can they find the details of today's podcast?
Yeah, great stuff today, guys. You can get to the show notes and everything that we've talked about today by going to seattleinvestorsclub.com/89. That's seattleinvestorsclub.com/89. And if you guys like what we're doing here, make sure that you hit the subscribe button. We also love to get reviews. So you can review us by going to seattleinvestorsclub.com/iTunes, and we'd love that.
And Keith, where can everybody reach you directly?
Directly on my cell phone is the best way to get a hold of me. 206-713-9063, or follow me on Instagram at kp.moneyman.
Ooh.
And yeah.
kp.moneyman. I don't think I've been on that one. I'll be checking it out. All right, guys, over and out for today. Thanks for listening, and we'll catch you on the next one.
Thanks for listening to the Seattle Investors Club podcast. If you have questions that you'd like to have answered on the show, shoot us an email at info@seattleinvestorsclub.com. Now go out, take that action, and build that real estate business. Thanks for listening.